Have you ever made a mistake that cost you thousands of dollars? I have, and it stings. That gut-wrenching moment when you realize a single decision just wiped out a chunk of your savings. But here's the truth. Mistakes are part of investing, as long as you learn from them. I've made some classic blunders, chasing hype, ignoring risk, and more, that set me back years. Today I'll break down my biggest financial regrets and show you how to avoid them. Let's dive in. Let's start by addressing one of the most common pitfalls in the world of investing, chasing hot tips and trends. It's a siren song that lures in many inexperienced investors. The promise of quick riches and overnight success is incredibly tempting, but it's rarely based on solid ground. I remember once I jumped headfirst into a hyped tech stock. It was during a time when everyone seemed to be talking about this particular company, and the stock was on a seemingly unstoppable upward trajectory. It felt like everyone online was saying it was the next big thing, a revolutionary company that would change the world. The fear of missing out, or FOMO, was definitely a major factor in my decision-making process. In my excitement, I ignored the fundamentals, those crucial indicators of a company's true value and potential. I skipped my research, neglecting to delve into the company's financial statements, its business model, or its competitive landscape. I didn't bother to understand how the company actually made money or what its long-term prospects were. Fueled by hype and a desire for quick gains, I invested way too much of my capital. For a few glorious days I felt like a genius, as the price soared higher and higher. I was convinced that I had discovered the secret to effortless wealth, until reality hit, and it hit hard. A mediocre earnings report, revealing disappointing financial results, sent the stock crashing down to earth. And just like that, my investment tanked, erasing all the gains and then some. I lost a significant amount of money and learned a painful but invaluable lesson. Never ever invest based solely on hype or someone else's excitement and enthusiasm. Always do your own thorough research. Read the company's financial statements, understand the underlying business, its strengths and its weaknesses, and most importantly, know exactly why you're investing in that particular company. Building long-term wealth isn't about chasing fleeting trends and get-rich-quick schemes. It's about making informed, well-reasoned, and disciplined decisions based on your own analysis and understanding. If you can't clearly and confidently explain your investment thesis beyond "someone told me it was a good idea," then it's time to walk away and reconsider your strategy. Your future, financially secure self will undoubtedly thank you for your patience and diligence. My next mistake? Putting all my money into just a few stocks I believed in. I thought diversification was for people afraid of big gains. But when my favorite sector crashed, my portfolio crashed with it. Diversification isn't just about owning lots of stocks, it's about spreading risk across industries and asset classes. Think of it like building a team. You need different players to win. The easiest way? Low-cost index funds or ETFs that give you broad exposure. Don't bet everything on one idea. Protect yourself with a balanced portfolio. It may not be thrilling, but it's the best way to avoid catastrophic losses. Slow and steady wins the race in investing. Learn from my mistake, diversify early. I once fell into the trap of thinking I could outsmart the market. It seemed so simple in theory, a game of buying low and selling high. The plan was straightforward: sell at the perceived top, capturing all the gains, and then buy back in at the absolute bottom, maximizing my investment. So, during what I thought was a minor dip, a temporary setback, I impulsively sold my stocks, convinced I was making a strategic move. I sat on the sidelines waiting patiently, or so I thought, for the inevitable crash, the market correction that would allow me to swoop in and buy everything back, at a discount that never came. To my surprise and dismay, the market didn't crash. Instead, it stubbornly rebounded, defying my carefully laid plans. As the market climbed higher and higher, I watched helplessly, missing out on huge gains, kicking myself for my failed attempt at market timing, stuck on the sidelines with my cash. I learned a valuable lesson. Timing the market with any degree of accuracy is nearly impossible, a fool's errand for most individual investors. Even the seasoned pros, with all their sophisticated tools and expertise, can't consistently predict market movements, let alone time them perfectly. The real secret to successful investing isn't about predicting the future. It's about embracing a long-term perspective. Time the market, not the market. The key is to stick to a well-thought-out long-term investment plan and invest regularly, consistently adding to your portfolio. Don't get swayed by short-term market fluctuations or react impulsively to whatever the financial headlines are screaming each day. Dollar cost averaging, investing a fixed amount at regular intervals, takes the emotional element out of the investment decision-making process. This strategy helps to smooth out your returns over time, reducing the risk of buying high and selling low. It's crucial to remember, don't let fear or greed, those powerful and often irrational emotions, dictate your investment moves. Instead, focus on the factors that you control, the elements within your reach that contribute to long-term financial success. This includes diligently managing your savings rate, consistently putting away a portion of your income. It also means carefully considering your asset allocation, diversifying your investments across different asset classes to manage risk. And, perhaps most importantly, it requires unwavering discipline, sticking to your investment plan through thick and thin. In the long run, let the power of compounding, the snowball effect of earning returns on your returns, do the heavy lifting for you, building wealth steadily over time. Another costly mistake I made was ignoring a fundamental principle of investing. I invested way beyond my true risk tolerance. I let the allure of high returns cloud my judgment, pushing me into investments that were simply too volatile for my comfort level. On paper, I thought I could handle big swings. I told myself I was comfortable with the potential for significant losses in exchange for the possibility of outsized gains. I convinced myself I had the stomach for it. In reality, I lost sleep and panicked during downturns. The theoretical risk I'd accepted became a very real source of anxiety and stress. Every market dip felt like a personal failure. Your real risk tolerance shows up when the market drops, when fear and uncertainty grip the market. That's when you discover your true capacity to handle volatility, not when it's soaring. It's easy to be brave when everything is going up, but true investing grit is revealed during challenging times. If your portfolio keeps you up at night, if you're constantly checking market updates and feeling a knot in your stomach, it's too risky for you. Your mental and physical well-being are far more valuable than any potential investment gains. Be honest about what you can handle emotionally and financially. Don't let ego or the desire for quick riches cloud your judgment. Use risk tolerance questionnaires to find your comfort zone. These tools can provide valuable insights into your risk appetite and help you make more informed investment decisions. Build a portfolio you can stick with through ups and downs, a portfolio that aligns with your risk tolerance and allows you to sleep soundly at night, even if it means lower potential returns. Steady, consistent growth is often preferable to the roller coaster of high-risk, high-reward investing. I rebalanced into more stable investments, shifting away from the volatile assets that were causing me so much stress. And I finally slept better. The peace of mind was worth more than any potential gains I might have missed out on. A good strategy you stick with beats a perfect one you abandon. Consistency and discipline are key to long-term investment success. Know yourself, understand your risk tolerance, and invest accordingly. It's the foundation of a sound and sustainable investment strategy. The silent killers of wealth, fees and taxes. I once ignored expense ratios and tax implications, thinking they were minor details. But high fees and frequent trading can cost you hundreds of thousands over decades. Always choose low-cost index funds or ETFs. Every fraction of a percent matters. Understand how taxes work. Long-term gains are taxed less than short-term, and tax-advantaged accounts like IRAs and 401(k)s can supercharge your returns. Invest for the long term and minimize unnecessary trades. Max out tax-advantaged accounts before investing in taxable ones. Scrutinize every fee and know the tax impact of your moves. Optimizing for fees and taxes is a guaranteed way to boost your returns. Don't let these hidden costs sabotage your future. Let's quickly recap the key takeaways. Don't chase hot tips or get caught up in the hype. Diversify your investments across different asset classes. Don't try to time the market, it's a losing game. Respect your individual risk tolerance and invest accordingly. Watch out for high fees and minimize the impact of taxes. These mistakes cost me thousands in the past, but now you can learn to avoid them. Do your own thorough research, build a well-balanced portfolio, invest wisely for the long term, and be sure to use tax-advantaged accounts whenever possible. Start investing today. Don't wait around for the perfect moment. Take decisive action, stay disciplined through market ups and downs, and patiently let your wealth grow steadily over time. If you found this video helpful, please like, subscribe, and hit the notification bell for more investing tips. Thanks so much for watching.